Hi, welcome to this my session to back up chapter 3 of the Little Book of Valuation. In this chapter, we're going to start on the basics of intrinsic value. And in the process, we're going to value a company that should be relatively simple to value, Kraft Heinz Corporation, but along the way, we're going to confront the details that go into valuation. So let's start by looking at a choice we all face when we sit down to value a business. If I give you a company to value, there are two ways you can approach the valuation. First, you can value the entire business. What does that mean? Remember, a business is funded with both debt and equity. You take the debt and the equity, you take projects, you take investments, you value the entire business. You look at cash flows then to both debt and equity investors, a pre-debt cash flow, and you discount it back at a weighted average of what each claim holder demands. Cost of equity for the equity investors, or cost of debt for the lenders. It's called the cost of capital. Cash flows to the entire business discounted back at the cost of capital gives you the value of the business. Now there's another way you can approach valuation. You can wear blinders and look at just the equity investors. You can look at the cash flows they get, which is the cash flow left over after debt payments, interest payments, principal payments, and discount those cash flows back at the cost of equity, the rate of return that equity investors need to make to invest in a company. That'll give you the value of the equity. Which one is better? I don't think it's a question of which one's better, because done right, you get the same value for the equity. If you value the business and then subtract out debt to get to a value of equity, or you value it directly. It's more a question of which one's easier to do, and we'll confront that question as we go through this session. So let's talk about valuation and the ingredients that go into value. Let's start with cash flows. Let's start with cash flows to equity. The simplest and most direct measure of cash flow to equity, especially if you're looking at a publicly traded company, is look at the tangible cash flows that stockholders in the company get from the company, which leaves you with dividends. The dividend discount model is the oldest intrinsic valuation model around, and it basically takes the dividends as the free cash flow to equity. You're saying, what's wrong with that? Well, we know that some companies don't pay dividends, and others have increasingly started supplementing dividends with buybacks, and there's no requirement that companies can afford to pay dividends have to pay them. So in other words, with dividends, we're looking at what companies actually pay out. We're not looking at what they could have paid out, potential dividend. One simplistic way of adjusting dividends for the fact that you have buybacks supplementing them is look at what I call augmented dividends, which is dividends plus stock buybacks. Look at how much cash a company has collectively returned over time. Now, if you're interested in finding out what a company could have returned, potential dividend, it's actually a surprisingly easy number to nail down, because everything you need to get that number is in one financial statement, the statement of cash flows. Here's how you get free cash flow to equity. You start with net income. Why? Because you're looking at cash flows to equity, you start with equity income. From that, you subtract out what the company is reinvesting. And I'm going to set up a process for thinking about reinvestment. Reinvestment, if you think about it generically, can take the form of reinvestment into long-term assets, land, building, equipment, machinery, and reinvestment into short-term assets, inventory, receivables. I'm going to measure the former by bringing in depreciation, because it's an expense that lowered my income. So think of that as a cash inflow. It's cash sitting in the bank, and netting it out against capital expenditures. If accountants stay true to their word, and sometimes they're not, we'll talk about what to do then. Capital expenditures should reflect what a company is putting into long-term assets, factories, equipment, etc. That difference between capital expenditures and depreciation is called net capex. Think of it as what the company is investing in its long-term assets. Now, if you look at short-term assets, it should be captured in your working capital. A retailer that's growing will have more inventory. More inventory ties up cash. Increases in working capital are reinvestments in short-term assets. So from my net income, I subtract out what a company reinvests. And the more it reinvests, the less there will be left over to pay dividends. But I'm not quite done, because this is free cash flow to equity. Remember, every time you borrow money, that's cash coming into the company. Every time you have to repay debt, that's cash leaving the company. So I bring in the net cash flows from debt. Either cash is coming in or cash is going out. So net income minus reinvestment, net of the debt cash flows, positive or negative, gives me free cash flow to equity. Fancy word, but basically is the potential dividends, what your company could have paid out in dividends. So let's try this. for Kraft Heinz Corporation. I've taken 3 years of data here. And if you're interested, the annual reports are online. You can download them and check for yourself. 2020, 2021, and 2022. I start with net income, as I said I would. I add back depreciation and amortization. And remember, it's all non-cash charges. I also add back what's called goodwill impairment. This is accountants coming in and writing down goodwill from previous acquisitions saying you paid too much. I add back those non-cash charges. Again, remember, you're adding them back because you subtracted them out to get to earnings, but it wasn't a cash expense. Then you subtract out CapEx, and here you should notice something strange at Kraft Heinz. In 2022, they did have a capital expenditure of $1.3 billion. But in 2021, the capital expenditure is a negative item, minus $4 billion. You're saying, what does that mean? Well, in 2021, Kraft Heinz actually divested assets, which also shows up in the investing activities, and those divested assets brought in a lot more than they invested. So they actually saw their capital expenditure be a negative number in 2021. In 2020, but you're back to a more normal CapEx year. As for the change in non-cash working capital, it's jumped around. It was a positive cash flow in 2020. Notice the minus $115 million means working capital went down, which means cash came in. It was a negative cash flow in 2021 and 2022. Pause right there. You can already see how the numbers jump around on a year-to-year basis. But stay true to the original calculation. What do you get if you net out CapEx and change in working capital from net income plus the non-cash charges? Is your free cash flow equity before you even looked at debt. And in 2020, that number was $4.2 billion for Kraft Heinz. In 2021, that number jumped to $7 billion, and in 2022, dropped back to $1.1 billion. But remember, you got to bring in debt raised, it's a cash inflow, and debt repaid, which is the cash outflow. Over this 3-year period, Kraft Heinz paid off a large portion of its debt. Good or bad, we're not going to contest that for the moment. But if you bring in the debt effect, the free cash flow equity was negative in 2021 and 2022. In principle, Kraft Heinz had no cash to pay dividends if it was based on that year's cash flows. In 2020, it had a positive free cash flow equity. So free cash flow equity is not rocket science. It's a measure of what cash is left over after you've met every conceivable need. What can this free cash flow equity be used for? It can be used to pay a dividend. It can be used for buybacks. When companies have large positive free cash flow equity, they can afford to pay dividends and buy back stock even if they don't do so. Now, we talked about looking at the entire business. It's called and looking at the cash flows that both equity and debt claim holders get from the company. It's called free cash flow to the firm. To compute free cash flow to the firm, you again start with earnings, but not with net income, because that's just to equity investors, but with operating income. Income before interest expenses. You act like you pay taxes on that operating income. I know you don't, but act like you do. So if your effective tax rate is 20%, you're going to net those taxes out. Then you subtract out the reinvestment, the same reinvestment we talked about in the context of free cash flow equity. But then you're done. You're saying, what happens to debt cash flows? Remember, when we're talking about the firm, debt holders are no longer outside the circle, they're inside. They're capital providers. So this is a cash flow before debt payments. It's called free cash flow to the firm. Now, I would suggest you compute both for a company and see how different they are, because you're measuring two different things. One is to just equity investors, the other is to the entire business. I tried that for Kraft Heinz, and the free cash flow of the firm reflects some of the quirks you saw with free cash flow equity. You start with the operating income, you act like you pay taxes. And again, I've stayed with the effective tax rate that each year, and you can see it jumps around. 65% in 2020 because it carried over taxes from previous years. You do the net after taxes. You add back depreciation, amortization. You add back goodwill impairment. You subtract out capital expenditures. With the quirk in 2021, divestitures were a huge number, and change in non-cash working capital. You get a free cash for the firm. The free cash for the firm was a big positive number. You're saying, how do I reconcile it with the negative free cash flows to equity that I saw before? Simple, right? What did Kraft Heinz do during these 3 years? It paid down a lot of debt. Since free cash for the firm is a pre-debt cash flow, you're looking at a positive cash flow before debt payments. So recognize the difference because that's the starting point. Now, before we move on, notice that these were for the last 3 years. I was doing my valuation in 2023. I have some good news and I have some bad news. The good news is these numbers you can nail down. They come from financial statements. The bad news is your value for KHC has nothing to do with these numbers. It's about projecting them in the future. And as you saw those numbers jump around on a year-to-year basis, you can see why when you make projections, you want to smooth things out. For example, you take the effective tax rate, 20, 40, and 65. You're saying, which one do you use? Well, you probably should look at the average tax rate across time. And the same can be said for a lot of the numbers that jump around. Incidentally, I isolated just the reinvestment number. Remember the capital expenditures, the depreciation, the change in working capital. And I computed it as a percentage of my after-tax operating income. You're saying, what does that tell me? It gives me what's called a reinvestment rate. It's a percentage of my after-tax earnings that I'm plowing back into the company. Is it good to plow back a higher number? Well, if you want high growth, you need to plow back a higher number, but it's not necessarily good if your investments are not good either. So in this case, if you look at the reinvestment rate for Kraft Heinz, because of the strange things that were happening in 2021 and 2022 with the divestiture, you're basically getting a reinvestment rate that was negative in 2020 and 2021. Stepping back, you look past the numbers, Kraft Heinz is not reinvesting very much, at least over this period. What does that tell me? When I tell my story and I try to value Kraft Heinz, it means the expected growth rate you should see at that company should reflect the fact that they're not reinvesting as if they think there's growth. So I should give them a low growth rate. So when you look at the past, it's not because you want to extrapolate the past. It's you want to understand your business. How much is it growing? How profitable is it? How much is it reinvesting? And at least looking at the numbers here for Kraft Heinz, it's not growing very much. It's reinvesting as if it has very little future growth. And if you look at the profitability, it's a decent number, but there's lots of drains on that profitability. Let's move on to risk. Chapter 2, we talked about the broad principles that govern risk, and we talked about how risk is measured as a risk added to a portfolio. And I talked about the 3 parameters we need to come up with a discount rate, at least in the CAPM. We need a risk-free rate. We need a beta, measuring the relative, and the risk-free rate will depend on the currency you choose to do the valuation. The beta that measures the relative risk of your company and the equity risk premium that captures the price of risk in equity markets. So we need these inputs to get to a cost of equity. So let's spend a little time talking about each of these inputs. I'm going to start with the risk-free rate and talk about what goes into a risk-free rate. How do you estimate it? You might think that's simple. I know how to do it already. Well, have some patience because it might not be as straightforward as you think it is, at least in some currencies. I want to talk about equity risk premiums, both the conventional way in which people estimate equity risk premiums and what I think is a much better way of estimating equity risk premiums. And third, I want to talk about, again, the conventional approach to estimating beta or betas. So what I'm going to say is going to apply just as much for the multi-beta models as it does for the CAPM. Let's start with the risk-free rate. For an investment to be risk-free, you need to know exactly what you're going to make with certainty. Let me repeat that again. For an investment to be risk-free, you need to know exactly what you're going to make with certainty, which means by definition, for something to be risk-free, the entity issuing the security can have no default risk. Now, when I did my MBA, which was a long time ago, I was told to use the government bond rate as my risk-free rate. And you can see the logic, right? When a government issues bonds in its own currency, it shouldn't default. And here's why. Even if it doesn't have the money, it can print the money. So at least in theory, you could argue government bonds should be default-free, and therefore you can use the government bond rate as a risk-free rate. I'm going to push back against that notion. In some currencies, the Swiss franc, I'm perfectly okay using the government bond rate. But if I came to you with a Brazilian government bond, even if it is in Brazilian reais, I would argue that that government bond might have some default risk that you've got to clean up for that default risk if you truly want to get to a risk-free rate. So the starting point is a risk-free rate, easy in currencies where there is a default-free entity issuing a security. I would argue that any government that's AAA rated, I'm outsourcing my measure of default risk here to the ratings agency. A AAA rated government, I'm okay using the government bond rate as my risk-free rate. If you're single A, triple B, double B rated governments, then I'm going to be a little more cautious and adjust the government bond rate for default risk. Let's talk a little bit about equity risk premiums. The equity risk premium is the price of risk in the equity market. Let me state that again. It's the price of risk in the equity market. What determines that price? Demand and supply. It's obvious, but that demand and supply are going to be driven by risk and greed. The equity risk premium is a number that reflects the balance between greed and risk that drives markets. When greed wins out, equity risk premiums get lower. People accept a lower premium. When fear overrides the greed, the equity risk premiums will go up. So at least in principle, you can see the equity risk premium should be a dynamic number reflecting that balance between fear and greed. Now, of course, the way people estimate equity risk premiums is really the question. The way in which most people get equity risk premiums by looking backwards. It's called a historical risk premium. In a historical risk premium, you look at the last 50 years, the last 75 years. You look at what stocks made on average over that period. Let's say it's 8%. What government bonds made on average over that same period. Let's say it's 3%. 8 minus 3 is 5%. It's called a historical risk premium. The problem with historical risk premiums is they're obviously backward looking because that's how we got them. And they're not dynamic, they're static. You could be in the middle of the worst crisis in history. You're terrified, fear is rampant. But with a historical risk premium, you're stuck with that number that you calculate at the start of the year, because how much can a 100-year average change, no matter how bad the crisis you're in? So for the last 30 years or so, I've been looking for a better way of estimating equity risk premiums. And I've come up with a way. It's got its own limitations, called an implied equity risk premium, where I look at what stocks are priced at now, what the expected cash flows are, and I back out from those expected cash flows an expected equity risk premium. Sounds fancy, but here's what I'm doing. I'm using in the stock market what people do in the bond market all the time, in computing a yield to maturity. The yield to maturity is the discount rate that makes the present value of the cash flows in the bond equal to the price of the bond. I'm doing the same thing with stocks and coming up with an expected return, an IRR for stocks based on what you paid for stocks and the expected cash flows. Saying how different can the numbers be? In the 30 years I've been computing them, there are periods where they're pretty close, like at the start of 2024, at the start of 2023, the historical premium was about 5.06%. And by the middle of 2023, the implied premium was about 5%. So using either would have given me roughly the same number. But there are periods where these can deviate. And when they deviate, my gut is to go with the implied premium, a forward-looking dynamic number. I get that premium for the S&P 500. It's easy enough to do. You think I'm done. Kraft Heinz is a U.S. company. I have a U.S. equity risk premium. What else is there to do? Kraft Heinz might be headquartered in the U.S., but it gets a significant portion of its revenues outside the U.S. And I'm going to state a proposition. The equity risk premium you should be using for a company should reflect where it does business, or geographies. I actually just look at the countries or regions of the world that a company operates in. Kraft Heinz, for instance, breaks their revenues down by region, and I take a weighted average of the equity risk premiums across the regions. Saying, why would equity risk premiums vary across regions? For obvious reasons. Countries, some parts of the world are riskier than others. So you get a significant portion of your revenues in Latin America and Africa. I have to incorporate that into your equity risk premium. Based on Kraft Heinz's geographical exposure, their equity risk premium was about 5.67% in the middle of 2023. It's got a risk-free rate. In the US, I'm going to stick with the T-bond rate, though we're getting pretty close to the point where the US itself might not be a default-free entity. But for the moment, I'm going to hold on to the hope that the US Treasury will not default. Use the 10-year bond rate as my risk-free rate. Why the 10-year bond rate? Because valuation is long-term. Your cash flows are over extended periods. It's simple duration matching. I should be using a long-term government security, not a short-term rate. I start with that as my risk-free rate. I use the equity risk premium based on the geographies KHC is exposed to. And then I look at the risk. The conventional way of measuring the risk in a stock is to run a regression of that stock's returns against a market index. The slope of the line is the beta. I don't like that approach. It's one slice of history. Strange things can happen. So here's what I'm going to do instead. And it stood me in good stead in all my years valuing companies, rather than run one regression for the company, I look at the business or businesses that the company is in and look at the betas of other companies in that business. So you're a software company. I'm going to look at the average beta for software companies, and I'm going to do cleaning up for the fact that you might have less or more debt than those companies. Basically, I call this a bottom-up beta, but I build up to a beta for a company by looking at the business or business it's in. With Kraft Heinz, it was a relatively simple exercise. They're in one business, food processing. I looked up the average beta for food processing companies and computed what the betas of companies operating in those businesses would be, cleansed of debt. It's called an unlevered beta. Sounds fancy, but I take the average beta across all food processing companies. I take the average debt to equity ratio across all food processing companies, take out the effect of debt. I come up with an unlevered beta of 0.69. Saying, where's Kraft Heinz debt? Wait, we're not quite done yet. I take the unlevered beta. I take the marginal tax rate for Kraft Heinz, which in the US was 25% in 2023. And I take the market debt and market equity that Kraft Heinz had. Kraft Heinz is about $19.8 billion in debt and market equity of $45 billion. That becomes the debt to equity ratio I use to re-lever the beta to reflect Kraft Heinz debt to equity. I come up with a levered beta of 0.92. So I've got my risk-free rate, I've got my beta, I've got my equity risk. I'll bring them all together in a moment, but I want to pause and think about the cost of debt. I'll lay out the principle here again. The cost of debt is the rate at which you can borrow money long-term today. Repeat that again. It's the rate at which you can borrow money long-term today. Not the rate at which you borrowed money 2 years ago, 5 years ago, 10 years ago. I don't care if you decided to use short-term debt. I'm going to take all your debt today, act like it's long-term, and ask what would it cost me to borrow the money today? Why? Because I'm valuing the company today, and I have to think about what would it cost me to acquire the company at today's cost, today's interest rates. So to get the cost of debt, I've actually made your life simpler. All you need to do is start with the risk-free rate. The same risk-free rate discussion we had earlier kicks in, either government bond rate, if the government is default free, or adjusted for default risk if the government has default risk. And then you add to it a default spread for the company, reflecting how much I worry as a lender when I lend money to a company. You're saying, how do I know what that default spread is going to be? For many of your companies, you'll get lucky. Somebody will have estimated the default risk in your company. Take a look at S&P, Moody's, ratings agencies. Much as we abuse ratings agencies, ultimately, they are the place we go to think about default risk. Because if you can get a rating for your company and that rating is reasonably close to its true rating, you're home free for the cost of debt. In the case of Kraft Heinz, the S&P rating for the company was BBB. The default spread for BBB rated companies in 2023 was 1.89%. The T-bond rate then was 3.8%. You add the 1.89 to the 3.8, you get a pre-tax cost of debt of 5.69%. Now, of course, there are companies which are not rated. You're saying, what do I do then? I use a very simplistic approach. I start with what's called the interest coverage ratio, which is the operating income divided by interest expense. In the case of Kraft Heinz, that ratio is 3.95. You're saying, what do I do with that? I have a lookup table based on rated companies where you tell me what the interest coverage ratio is. I'll guess the rating. The rating I get is A-, surprisingly close to the actual rating, a little higher, which will give me a smaller default spread. To be honest, if I'd used the 1.54% default spread here, wouldn't have made much of a difference in my final valuation. So you have a rating, use it. If you don't, you can estimate what's called a synthetic rating, doing what I just did, and use it to come up with your cost of debt. I think I'm ready to compute Kraft Heinz cost of capital. For the cost of equity, I start with the risk-free rate, 3.8%, 10-year T-bond rate. I take the levered beta that I got by looking at companies trading in the food processing business, 0.92. The advantage of taking an average beta across food processing companies, it's going to be much more precise, the law of large numbers. And if you have a business mix that's changing, you can reflect that in your beta. And I multiplied by the 5.67%, which is the equity risk premium for Kraft Heinz based on its geographic exposure. My cost of equity is about 9%. For the cost of debt, I start with the same risk-free rate. I add the default spread based on the actual rating, BBB, 1.89%. And I net out the tax effect. You're saying, what are you doing? Remember, interest expenses are tax deductible. The government subsidizes debt to an extent. So when I pay 5.69% of my debt, because I get a 25% tax saving, in effect, I'm paying only 4.27%. You're saying, why aren't you doing that with equity as well? Because governments are unfair. When it comes to equity, you've got to make your payments out of after-tax cash flows. But with debt, they give you a hand with the tax law. The cost of capital is a weighted average of those two numbers. Remember, the market values of equity and debt were already specified. 44.8 million for equity, 19.5 billion for debt. I take a weighted average of my cost of equity and my after-tax cost of debt and end up with the cost of capital for Kraft Heinz of 7.56%. So that's my discount rate. I've got it nailed down. Let's talk about growth. There are three ways, again, generically we can estimate growth. One is to look backwards, historical growth. And a surprisingly large number of valuations you see just extrapolate past growth. The problem, though, is past growth might not be a good predictor of future growth. When the company is being disrupted, the business is changing. Past growth might also not be a good predictor of future growth if your company has gone from being a small company 10 years ago to a large company today. It's one thing to grow 30% a year when you have 100 million in income. It's an entirely different game to grow 30% a year when you have $10 billion in revenues or income. Second, you can look at what other people are estimating as growth for a company. Again, a surprising number of valuations. People outsource growth. They ask management, they ask analysts on the misguided belief that they're much better at forecasting earnings and growth than you are. The only thing this accomplishes is basically you can blame somebody else if things go wrong. Analysts are not that good at forecasting growth, and by joining in with the crowd, you're defeating the entire point of intrinsic value, which is you think for yourself. It's historical growth, analyst growth. You can look at what fundamentals are telling you about growth. You're saying, what are you talking about? Ultimately, neither you nor I have the power to endow companies with high growth. For a company to grow, it's got to reinvest a lot and reinvest well. What does that mean? Remember, we talked about the reinvestment rate as the reinvestment, what you put into your company as a percentage of your after-tax operating income. If you're looking at growth in operating income, you can look at that reinvestment rate. That number is a high number, you're more likely to grow in the future. But that's only half the equation. To grow fast, not only do you have to reinvest a lot, you've got to reinvest well at the same time. In chapter 2, we talked about return on invested capital. And if you believe your company is picking good projects, earning a 30% return on capital, and reinvesting 80% every year, its growth rate can be 24%. Why is it so high? Because it's reinvesting a lot and reinvesting well at the same time. Incidentally, if you're doing everything in equity terms, rescale these numbers in equity terms. Instead of looking at the overall reinvestment rate, you look at the percentage of net income you don't pay out in dividends. So looking at return on invested capital, you look at return on equity. But you're still doing the same thing. You're looking at how much is this company reinvesting and how well is it reinvesting. Took us a while to get there, but I think we're ready to forecast Kraft Heinz free cash flows. Remember all that volatility in the 3 years that I showed you as historical years? My job when I do valuation is to look past the volatility. So basically, when I think about valuing a company, I think about three big drivers: growth, profitability, reinvestment. With Kraft Heinz, I don't think there's much growth. What do I base it on? First, on history. They're not growing very much. Second, on their own behavior. They're not reinvesting very much. Third, from what I know about the company. This is a company that's been around a long time, produces 57 types of ketchup, none of which tastes good, and cheese that stays melted for the rest of eternity. Its core market is aging. It's not growing very much, and I don't see a way it breaks out of that. So at least my valuation, I give them low growth, 2% a year for the next 5 years in nominal terms. That might even be less than the inflation rate. And then I get even more pessimistic. I lower that 2% growth down to 1% in linear increments. So basically low growth. I do assume that they will find a way to cut out some of the less profitable products, get less ambitious, and improve their margins gradually over time from 13.72% to 15%. Those higher margins are coming primarily from cost cutting. They're now a mature company. They don't have to overreach. And the reinvestment is a relatively small number. The way I get the reinvestment here is by looking at the change in revenues every year and estimating how much they will need to reinvest. And so they're not growing very much, they're not reinvesting very much. After-tax operating income minus reinvestment gives me free cash flow to the firm. This is a company with large and growing positive cash flows, but the growth rate is relatively moderate, which is what I'd expect given where the company is in its life cycle. Now, I did that for the next 10 years. You think, what happens after year 10? After year 10, I'm getting a little tired. I don't want to estimate cash flows each year. And in this case, I can put in closure. So by the time I get to year 10, Kraft Heinz is growing at 1% a year. Its margins have settled in. It's reinvesting what it needs to. It's what you call a mature firm. When you have a company that's a mature company, you can essentially put closure by assuming your cash flows grow at a constant rate forever. Again, I hate to hark back to chapter 2, but remember in chapter 2, we talked about a growing perpetuity. If I assume after year 10 that my cash flows at Kraft Heinz will grow at a constant rate forever, I can use that growing perpetuity equation to get what's called a terminal value. Now, incidentally, while many discounted cash flow valuations end with a terminal value, you don't have to always have a terminal value. There are some companies, real estate-based companies, or a company based on a key person, who when that person passes on, the company's existence is in threat. You might do a liquidation value. We look at what you will get if you sell the assets. One final adjustment you might make is I did use a growing perpetuity to get the terminal value, but you don't have to even assume a perpetuity. You can assume your cash flows will continue for 15 or 20 years, growing at 3% a year, a growing annuity to get a terminal value. So there's a lot of flexibility in the terminal value calculation, which we don't use. With Kraft Heinz, I will assume a 1% growth in perpetuity and then give it all the characteristics of a mature company. What does that mean? Well, first, if I have only a 1% growth rate, my reinvestment rate can be pretty small, right? To get that reinvestment rate, I take the growth rate and I divide it by the return on capital that I think Kraft Heinz can maintain in perpetuity. 1/10 gives me a reinvestment rate of 10%. They'll have to reinvest only 10% of their after-tax operating income. Why so low? Because their growth is low. Now for the terminal value, I get the after-tax operating income in year 11. It shouldn't be year 6, but year 11. I multiply it by 1 minus the reinvestment rate and divide by the difference between the cost of capital, which by year 10, I'm down to 7.5% minus the growth in perpetuity. I get a terminal value of $49.3 billion, but remember, it's the end of year 10. I need to discount it back to today using my cost of capital. So little caveat on discounting. Because I allow the cost of capital to change over time, not by much, from 7.56 to 7.5%, you cannot use the present value function in Excel anymore. You have to actually compute what's called a discount factor. It's not rocket science, so don't freak out. So here's how the discount factor will get computed. For the first 5 years, use a standard present value equation. But starting in year 6, you compute what's called accumulated cost of capital. What does that do? It brings in the changing cost of capital and it gives you a discount factor. So I take the cash flows in each year, multiply by the discount factor, and in year 10, remember the terminal value gets discounted back as well. I add up those present values. What I get as a value from my operating assets is $44.5 billion. I'm almost home, but here are the loose ends I need to tie up. Once you've taken free cash for the firm, discounted them back at the cost of capital. First stop you got to make is to bring in what you haven't counted yet. So to begin with, to compute free cash for the firm, you start with operating income. So whatever is not an operating income hasn't been added back yet. I don't want to be mysterious, but if you have a big cash balance, Google has 110 billion, Apple has 160 billion, you haven't counted the cash balance. Why? Because interest income from cash is not part of operating income. So I'm going to add back the cash balance. That's the easy part. If you have cross holdings in other companies, 10% of another company, 5% of another company, 25% of a third company, those are called minority holdings. And the income from those holdings shows up below your operating income line. So you got to bring them in too. Then you got to subtract out any other potential liabilities. You've got to subtract debt and other. So you've got unfunded healthcare obligations, lawsuits that you might be facing. This is your last chance to clean up for them. You subtract them out in addition to the debt. And as a final stop, if you've been giving your employees stock-based compensation, there's cleaning up to do, right? Especially if you've given them options. The value of those options needs to be netted out from your value of equity before you divide by the share count. So here's what it looks like for KHC. I start with the value of the operating assets. I add cash. They don't have cross holdings, so I didn't have any minority holdings to add back. I subtracted our debt, and there were a tiny amount of management options. You see, why do you even bother? Here wouldn't have made much of a difference if I'd ignored this, but if it's a big tech company, the management options can be a drain on your value. I come up with $25.4 billion as the value of equity in the common stock. I divide by the number of shares outstanding, and I divide by the actual, so don't double count by bringing in the shares underlying the options. I come up with a value per share of $20.60. I'm done, right? But this is a publicly traded company. The stock was actually trading at about $30 per share. So what does that tell us? One of three things. One is that I've screwed up in my valuation, that I've made wrong assumptions about future growth potential and riskiness. It's always the most logical place to start, is you're wrong. The second is the market screwed up, that the market is wrong and you're right. The third is you're both wrong. The question is, who's more wrong? So one way to assess this is to actually compute what your break-even point has to be to justify the market price. So I take my two big assumptions. One is about revenue growth in years 1 through 5, and the second is about what my margin will be by the time I get to steady state. And I compute what my value per share will be at different combinations. Obviously, the higher the growth and the higher the margin, the higher the value per share. See those highlighted numbers though? Those are the numbers that exceed the stock price. So you would need much higher revenue growth and a much higher margin to get there. So another way to reframe this investment is, if you look at the stock and you believe you could be this wrong on growth and margins, then obviously you could reach to buy the stock. But for this stock to break even, it would need to grow 6 to 8% a year and have 20% margins. At least based on what you see in Kraft Heinz today, that'll be a tough sell. So I hope you found this session useful, and I thank you very much for listening.